Okay, thanks very much, Peter. So good morning and welcome. In this session, we're going to provide an update on the capital market opportunity set. And we're also going to shine the spotlight on one particular asset class, an asset class that is tremendously important, an asset class that just experienced an extraordinary year, an asset class that gets less attention than it deserves, an asset class that's not immune to the valuation cycle. Of course, I'm talking about government bonds. And it was through the actions of central banks that the very characteristics that investors had come to depend upon from government bonds were taken away. So their role in portfolios became increasingly questionable. And this culminated last year. So we're going to look back at 2016 and show just how bad the situation became. First, let's look at the performance of the major markets over the course of 2016. From start to end, it was a year in which not much changed. But in between, a terrible lot happened. Most major markets provided returns of somewhere between 2 and 14%. But that masked the large shifts experienced by some asset classes, like listed property, like fixed income, throughout the year. This was one of the most extraordinary years ever for bonds. At one point, with negative yields in play, some bond markets around the world were trading at levels that represented 5,000-year lows. And as yields that had never been seen before. Here in Australia, we also experienced record low bond yields. On the 2nd of August 2016, our 10-year bond yield hit 1.82%. And these low bond yields, they reverberated across REIT and infrastructure markets as investors searched desperately for yield. The first 7 months of 2016, A-REITs were up by over 22%. And then something quite interesting happened. The penny finally dropped that at some point the US Federal Reserve was again going to raise interest rates as inflation expectations started to build. The Bank of Japan announced it was going to target a positive yield curve, allowing long bond rates to drift up to at least zero. And of course, there was the election of Donald Trump. By the middle of December, the yield in the Australian 10-year and the US 10-year bond had risen 100 basis points from their respective lows. All of a sudden, an asset class that was supposed to be known for its capital stability in the back end of 2016 had lost capital. And again, the consequences, they reverberated across REIT and infrastructure markets. So the last 5 months of the year looked very different to the first 7 months of the year. And that's what this chart shows. In blue, we see the performance of each asset class in the first 7 months to the end of July of 2016. In green, we see the performance of each asset class in the last 5 months. What you can see here is that Australian bonds, Australian listed property, global bonds, global listed property and infrastructure each performed very well in that first period. Well, they each lost capital in the last 5 months. So in this session, we're going to lift the lid on what drives returns for bonds and highlight why, as with most assets, a set and forget approach is far from ideal. So, why do bonds matter? I'd suggest to some investors they don't matter much at all, but to others they are terribly important. We know that as people move through their life cycle, their needs and requirements change, and so therefore should their asset mix. Early in life, the biggest asset that most people have is their human capital. That is their future ability to save and invest. Now, human capital for some occupations looks very different to others. Human capital for a teacher looks very different to the human capital profile for a mining executive. Human capital for a teacher has a risk-reward profile much more like a bond. Human capital profile for a mining executive looks much more akin to an equity. But what that teacher and mining executive both share in common is the reality that as they age, their human capital depletes. Hopefully at the same time, their financial capital grows to offset that declining human capital. But the point is that as people move through their life cycle, their needs and their requirements change, their assets and liabilities change, and so do the risks they face. And so therefore should their underlying asset mix. As you all well know, it makes sense to hold higher equity allocations when a client's younger. But as they move towards retirement and into decumulation phase, potential drawdowns of 40 or 50 or even 60% are simply not feasible to many. So equity allocations tend to ratchet down based on some kind of formal or informal glide path, like this one, where you can see equity allocations starting high and as the investor ages, equity allocations decreasing. Important to note, this is just one possible glide path. The reality is that there are many potential glide paths that could be used for investors, depending on their assets, their liabilities, their occupation, whether or not they're a teacher or a mining executive, depending on their willingness and ability to tolerate risk. But in most cases, defensive allocations increase as a client ages, and that means more exposure to cash and more exposure to bonds. And within fixed income, as a client ages, there's this need for capital stability and liquidity that means shorter duration bonds potentially become more important. While at the same time, an ongoing requirement to grow the portfolio, at least in line with inflation, means inflation-linked bonds potentially have a greater role to play. But again, the point is, as an investor ages, the potential role for bonds of all kinds grows in importance. So, what can we expect from bonds in the long term? I'm going to answer that question with reference to our expectations for Australian equities, Australian cash, and Australian fixed income. And I want you to imagine a scenario in which each of those three assets are priced at fair value. Okay, under that scenario, valuations don't matter. Under such a scenario, we'd expect Australian shares in the long term to provide a real return of somewhere between 5.5% and 6.5%. We'd expect Australian bonds to provide a real return of somewhere between 2% and 3%, and cash a real return of somewhere between 1% and 2%. Those numbers are broadly consistent with what has been provided by markets in the long term. You can see here since 1900, Australian shares have provided a real return of 6.7%. Over that time frame, Australian shares were the second highest performing market out of the 21 countries listed on the DMS database. So Australian shares were very lucrative over that time frame. You can see that Australian bonds over the period since 1900 provided a real return of 1.7 and cash a real return of 0.7%. The story was broadly similar over the 50 years since 1966. Over that time frame, Australian shares were not quite as lucrative, but still very strong, providing a real return of 5.8%. However, cash and fixed income each provided much higher returns over that particular period. In the case of Australian bonds, we saw real returns of 2.7%, and in the case of cash, real returns of 2.2%. Now, there's one very big problem with all of these numbers. They're extremely long-term, and as a consequence, valuation gets heavily diluted. Valuation does not matter over a period of 100 years or more. I know very few clients that genuinely have an investment horizon of greater than 100 years. The reality is that over periods of 10 years and 20 years, valuations matter. The price you pay will impact the return you get. Not only will it impact the return you get, it will impact the level of risk that you bear along the way. And unfortunately, right now today, we have a situation where these three assets are not trading at fair value. Within equities, we have a situation where valuations are elevated. Within bonds, we have a situation, despite the fact that yields rose in the back end of last year, they remain significantly below long-term averages. Therefore, the prospect of generating average returns from this point in the cycle remains very, very, very low. There was the late, great US baseball player, Yogi Berra, who once said, "The future ain't what it used to be." And that couldn't be more true today when it comes to these three asset classes. So we know the prospects for equities change as valuations ebb and flow. And it's the same for bonds as well. Investors typically buy bonds for three key reasons: income, diversification, capital preservation. The problem is those characteristics are not ever present. Sometimes they're there in abundance, like leading into the GFC. Sometimes they're hardly there at all, like throughout last year. So we're going to look at two hypothetical Australian Commonwealth Government bonds issued at various points in time, each with a maturity of 10 years. The first bond we're going to look at was issued at the end of October 2007 at the prevailing yield of 6.2%. And because of that high yield, at that time, you had excellent income, you had excellent diversification, you had excellent capital preservation potential. And that was proven to be the case. Over the ensuing period, as equity markets faltered, bonds came into their own, providing positive performance back into portfolios. In contrast, a bond issued at the end of July last year at the prevailing yield for a maturity of 10 years would have been issued a touch under 1.9%. Because of that low yield, you had very poor income, you had poor diversification, you had poor capital preservation potential. Because of that low yield, there was a very high probability that in fact yields were going to rise. That's exactly what they did in the back end of last year, delivering capital losses to owners of long-term government bonds. It was US fund manager Leon Cooperman who said in the middle of last year that buying a bond is like standing in front of a steamroller to pick up a dime. You might get away with it, but it's very risky. There's no coupon to bail you out. I've said it before, 2016 was an extraordinary year for bonds, but not in a good way. I think 2016 will go down in history and rank alongside the tech boom for years to come. At one point last year, there was 11.7 trillion US dollars held in bonds paying negative yields around the world. Of that, 7.9 trillion was in Japanese debt, paying negative yields, and over $1 trillion in both German and French government bonds, again paying negative yields. And this chart shows just how bad the situation was. On the left, you see a list of countries, and on the top, you see tenors. In light green, you see those countries and tenors paying or offering up a negative yield on the 6th of July of last year. You see across the top, Switzerland, offering negative yields from 1 through to 50 years. So anyone stupid enough to buy a Swiss government bond at that point was paying for the privilege for the next 50 years just to get their capital back half a century later. You also had negative yields in Japan out to 20 years, Germany out to 15, Netherlands, France, Belgium, Sweden, Denmark, Spain and Italy, all providing negative yields at some point on the yield curve. Now, the authors of A History of Interest Rates, a very important book chronicling the long-term performance of fixed income markets, Sidney Homer and Richard Seiler, they went back 5,000 years. In that period, they were not able to find any instance of negative yields. These were the lowest bond yields in 5,000 years. So, what were the implications for investors? Well, we're going to turn back to Australia and we're going to again look at a case study. So what is a government bond? In effect, a government bond is nothing more than a loan to the government, where in return for providing that capital, you receive a coupon. That coupon needs to compensate you for the various risks. Those risks include the potential for inflation to rise above what you expect, the potential for the creditworthiness to decline, the potential for interest rates and yields to increase, leaving you nursing a capital loss prior to maturity. Now, we're going to look at a hypothetical Australian government bond issued on the 2nd of August of last year, again for a period of 10 years. That's when yields bottomed. That's when yields here in Australia hit 1.82%. Now, the government didn't issue a bond at that time, but by gee, it should have. And had they, this is what the cash flow payoff would have looked like, broken up into $100 increments, where in effect you outlay $100 and every 6 months you get back a coupon. And that coupon would represent 91 cents. That's that blue dot that you can barely see every 6 months. And then at the end of the period, you get back your final coupon and a capital payment. That capital payment, though, is not $100. It's $100 less inflation. And if inflation averages 2.5% for the next decade, that $100 turns into $78. You lose $22 due to the impact of inflation. And it's not just the principal that inflation affects, it's the coupon as well. And the further out that coupon, the more inflation diminishes the real value of that. Inflation is one of the biggest risks when it comes to bonds. And that's because the principal and the coupon are fixed, and the real value therefore will fluctuate depending on what inflation does. So again, we're looking at that hypothetical bond issued on the 2nd of August of last year at a yield of 1.82%. And what this chart shows is the real return of that bond under various inflationary scenarios. In a scenario in which inflation is low, a scenario in which inflation is moderate, and a scenario in which inflation is high. The best possible scenario for fixed income for nominal government bonds is deflation, because the coupon is fixed and so is the principal. The coupon and the principal cannot decline in line with prices. Bonds are one of the few assets that will perform well under that scenario. Okay, so we're looking at this bond issued on the 2nd of August last year at a yield of 1.82%. Under a scenario in which Australia provides negative inflation for the next decade of -3%, that bond looks quite good. That bond will provide you with a real return of just under 5%. Even if inflation for the next 10 years averages -0.5%, you still look okay, with a real return of just over 2%. However, if inflation hits a more moderate outcome, if inflation, for example, averages for the next 10 years 1.5%, you're staring down the barrel of returns that are only slightly positive in real terms. And if inflation hits the midpoint of the RBA's target band at 2.5%, that is when you're looking at negative real returns. And under scenarios in which inflation is higher, the outcomes look awful. So inflation of 3.5% to 4.5% will provide you with real returns of somewhere between -1.6% and -2.6%. Now, those defending low bond yields in the middle of last year were suggesting that as long as you held that bond through to maturity, you wouldn't lose money. Well, in real terms, under a range of inflationary scenarios, that was absolutely false. The problem was investors were accepting the prospect of almost zero real returns at times last year. And this chart shows the Australian 10-year government bond rate over the period spanning from 1985. And you can see that bond rate there in orange. And it's broken up into two components. The first component I want to call out is implied inflation. So that represents the market's expectations on what inflation is going to do for the next 10 years. We work that out by looking at the difference between the yield on the 10-year government bond and the yield provided by an inflation-linked bond over the same period. That difference is known as break-evens. That difference represents what the market expects inflation to do for the next 10 years, implied inflation. You can see implied inflation in 1985 was very high. That corresponded with a period in which inflation itself was high. But as inflation started to dissipate, so did inflation expectations. And you can see they've remained relatively low since. Well, they got very low in the middle of last year. At the end of July, inflation expectations got down to 1.6% for the next 10 years. That was the first problem with where yields got to. The second problem was the real yield. So that is the component over and above that implied inflation back up to the 10-year bond yield. So the difference. You can see that shown there in dark green. You can see real bond yields were very high in the 80s. They were high in the 90s. They were high in the 2000s. They weren't so high last year. In July, August last year, real bond yields got down to 0.22%. So you had very low inflation expectations. You had paper-thin real bond yields. And as you can see, yields rose in the back end of 2016. And within that, real yields and inflation expectations both drifted up. So inflation expectations went from 1.6% at the end of July to 1.9% by year's end. Here's the other problem with where yields got to last year. If you're going to lend money to somebody for a long period of time at a fixed rate, you typically only do so on the basis that you're going to get a higher return from that as compared to what you thought you could get from leaving the capital in the bank. And that's known as the term premium. That term premium needs to compensate you for the risks associated with holding that fixed rate bond. The risk that inflation rises, the risk that the credit worthiness declines, the risk that yields increase, leaving you with a capital loss. Let's say you wanted at least 1% more to buy a 10-year government bond over and above what you expect cash to do for the next decade. The question is, what would cash need to average for the next 10 years to justify buying bonds at the end of July last year? And that's what this chart shows. Here in Australia, we had 10-year bond yields at just below 1.9%. So for you to get your 1% premium out of that bond, cash in Australia would need to average 0.87% for the next 10 years. In the United States, we had 10-year government bonds at the end of July at around 1.5%. Again, to get your 1% premium, you would need cash in the United States to average 0.45% for the next 10 years. In the United Kingdom, following Brexit, 10-year bond yields were down to 0.7%. Again, to get your 1% premium out of that bond, in the UK, cash rates are going to need to average minus 0.3. The situation in Germany, the situation in Japan was terrible. In Japan, you had 10-year government bond yields trading at minus 0.2%. Hence, to get your 1% premium out of that bond, you're going to need Japanese cash rates for the next decade to average minus 1.2%. Now, we know cash rates were low. We know cash rates were low at the end of July last year. And that's what we show along the bottom here. Here in Australia, the cash target rate was 1.75%. A few days later, the RBA cut. In the United States, cash rates were 0.5%, same in the UK. Germany, they were 0. On some tranches in Japan, they were very slightly negative. So cash rates were low. But they needed to go substantially lower in order to justify the yields that we saw at the end of July, early August last year. The only way it made sense to buy bonds at that time was to make very pessimistic assumptions with regard to inflation, to make very pessimistic assumptions with regard to cash rates. And neither of those scenarios remained very likely. The most likely scenario was, in fact, that bond yields were going to rise. And that's exactly what we started to see in the back end of 2016. And the longer the maturity, the greater the capital loss. This chart shows two Australian Commonwealth Government bonds with two different maturity levels. Bond number 1 matures in 2039, so it's a long maturity bond. Bond number 2 is a shorter maturity bond maturing in October 2018. And it shows the drawdown of these two bonds in the back end of last year as yields started to rise. And you can see bond number 1, the long maturity bond, suffered major drawdowns as yields started to increase. That bond, maturing in 2039, lost around 18% of its capital value. Bond number 2 fared a lot better. As yields started to rise, because of its short maturity, it only lost 2%. So the way in which we measure that sensitivity to changes in yields for bonds or bond portfolios is by looking at its duration. The best way to think about duration is by an example. So a duration of 7 means that for every 1% change in yields, you're looking at a 7% change in prices, up or down. Here's the problem. Duration for both local and global bond indexes has been increasing markedly over recent times. And that's what this chart shows. It shows the duration for the Bloomberg Barclays Global Aggregate Index since 1992 as the green line. You can see the extent to which duration has increased over that period on the right-hand axis, from around 4.5 years to a little bit under 7 years throughout last year and into today. Now, that particular bond index comprises of government securities, high-grade credit securities. And more than half is invested in government bonds. So it's very relevant to show exactly what government bond yields have done over that time frame. And that's what the dark red line shows. You can see the extent to which 10-year government bond yields have come down over that time period. You can see how low they got in the middle of last year. So in the middle of last year, we had a situation where yields were at their record low point, that is, the compensation was at its record low point, the reward was at its record low point, and yet the risk, the sensitivity to changes in rates, was at very high levels. Now, long duration was wonderful as yields were falling, delivering capital gains through to investors. It whacked investors in the mouth in the back end of last year as yields started to rise. And it was the same here in Australia. Our composite bond index has seen an increase in duration from around 3 years at the time of the GFC to 5 years today. And again, that longer duration exacerbated the losses that investors felt by investing in government bond indexes both here and abroad in the back end of 2016. I want to spend a moment looking through time and breaking down the returns provided by global bonds. And then in a moment, we're going to look forward and show you exactly what our return expectations were for global bonds at various points in time throughout last year. So this chart, again looking at the Bloomberg Barclays Global Aggregate Index, shows returns for that index over various points in time. It shows returns in the 90s, returns in the 2000s. It shows returns in 2010 to 15 and then last year. And it breaks those returns up into 3 key components: the price, the coupon, as well as currency. For reference, it also includes Australian inflation. And you can see in the 90s just how large that coupon was. That's the fundamental reason, as Chris said, for buying bonds. You're buying the coupon. Now you can see the coupon is diminished over every single one of those periods. And that reflects the fact that in the previous chart, we saw yields declining. And because yields fell over every single one of those periods, you were delivered a capital gain over every single time frame. And you can see prices, the building block in blue, was positive. That wouldn't have been positive had yields risen over any one of those periods. It's been an extraordinary period for bonds. The other building block worth calling out is currency. So that currency component comes about as a consequence of the portfolio, the global bond portfolio being hedged. And the way in which that hedge is priced is such that you get the difference between cash rates in Australia and cash rates overseas. And because cash rates in Australia have typically been higher than most developed markets around the world over that time frame, that currency component's been quite lucrative. And you can see that. You can also see in 2016 the currency component declined relative to the previous period. And that reflected the fact that our cash rates here in Australia declined relative to the rest of the world. Now, this is history. What we spend most of our time thinking about is the future. We do that via our global capital markets frameworks and processes. It's a process through which we model hundreds of assets on a monthly basis. One of those assets is global bonds. And this chart shows our valuation implied returns for global bonds at various points in time throughout last year. So valuation implied returns represent our return expectations based on our valuation models over the long term. And this chart shows those return expectations in real terms, including the currency component. You can see that at the end of March, we were expecting from global bonds a return of around 0.5% for the next decade. As prices rose throughout the middle of the year, yields declined, so did our return expectations. They got down to minus 0.2% by the end of July. Then, as the back end of the year started to move on and yields started to rise and prices started to fall, our expected returns again started to increase. So you can see by year's end, we had expected returns for global bonds back up to 0.5%. It was exactly the same trajectory experienced by Australian government and Australian composite bonds, where they became incredibly unattractive in the middle of the year before starting to improve again as yields rose in the back end of 2016. Unfortunately, the same cannot be said for Australian and US shares. Unlike bonds, they did not experience a loss or price decline in the back end of 2016. Quite to the contrary, Australian and US shares experienced an increase in price over that period. So you had a situation where Australian and US shares started the year expensive and ended the year even more expensive. And that coupled with the fact that bond yields, despite increasing in the back end of last year, still remain significantly below average, meant that the valuations for mainstream equity markets and mainstream bond markets remained very elevated. Hence the prospects for strategic set and forget investors from this point of the cycle holding mainstream assets, we think remains very poor. The way we deal with this challenging environment is by looking high and low, across countries, regions and sectors, across equities and bonds, across emerging and developed, in an effort to identify those assets that are attractive from a risk-reward perspective, and then incorporating those assets into the portfolios. And that's what Daniel and Andrew are going to talk to you about over the course of the morning. But from me today, I want to make one more point in relation to 2016. So 2016 was a year in which central banks were made out to be key culprits in the rise of populism. That followed years of central bank liquidity driving prices up for equity markets and bond markets to the point where we got to record levels. That was fine if you owned those assets. It wasn't so fine if you didn't, and many were left feeling disillusioned. As James Grant so eloquently said last year, rising asset prices did nothing for the world's unprofitable voters. One thing you cannot dispute is that central banks were complicit in creating one of the biggest bond bubbles that we have ever seen. The point of today wasn't that bonds are bad. By gee, they were bad at times last year. We know all assets go through cycles, periods in which expected returns are high and periods in which expected returns are low. And just because a client's nearing retirement needs to de-risk, needs to reduce equity exposure, needs to target income, does not mean they buy bonds at any price. Valuations always will and always do matter. And then finally, in the current challenging environment, we think a set and forget approach is unlikely to suffice, making active valuation-driven investing more important than ever. The good news is markets can move quickly, but portfolio exposures need to reflect these changing prospects. And that's what Daniel and Andrew are going to talk to you about next. But from me today, thank you very much.